Did you hear about the brand new 2026 tax loophole designed just for single women? The one that supposedly rewards you for being single and successful, hiding in plain sight, ready to save you thousands? Okay, I have to be honest with you, because honesty is the entire point of this channel. That specific loophole, the one making the rounds online right now, it does not exist. There is no secret credit with your name on it just because you happen to be a single woman. I know. I am sorry. But please stay with me. Because the real story is actually better than the fake one. And almost nobody is explaining it correctly. Here is the truth. There is a genuine, completely legal tax sweet spot for single women earning under $200,000 in 2026. It is not a gimmick. It is not gendered. It is sitting right there in the real tax code, in black and white, and used correctly, it can save you thousands of dollars and put real money back into your monthly budget this year. The only catch is that you have to understand how it actually works, not how some viral post pretended it works. And by the end of this video, you will. I am Jenna, and on this channel, we do not sell you fairy tale hacks. We hand you the real levers, the ones the tax code genuinely gives you, and we show you exactly how to pull them. Today, we are breaking down the real 2026 advantages for single women earning under $200,000, where the money actually hides, why this income range is a genuine sweet spot, and the one strategy that quietly saves the most. Stick with me to the end, because that final strategy costs you nothing to set up, and most people never even hear about it. But first, let me clear the air fast, because there is a lot of nonsense circulating right now, and believing it can genuinely cost you money. So let us kill 4 myths in one breath. Myth 1. There is no tax law anywhere in this country that targets women, single or otherwise. The tax code does not know your gender and does not care about it. Any post promising a women-only credit is trying to sell you something, or worse, trying to get you to file something wrong. Myth 2. There is no solo homeowner incentive that pays single people just for maintaining a house. That one is completely invented. Myth 3. There is no independent filer credit expansion. Also made up out of thin air. And myth 4, the big one. There is no Secure Act 3.0. The real law is called Secure 2.0. It passed back in 2022, and every single retirement change happening this year flows from that law, not some shiny new one that just appeared. Oh, and one more, because this one matters for a lot of you. Catch-up contributions do not start at age 30. I have seen that claim absolutely everywhere lately, and it is simply false. The real catch-up age is 50. We will get into exactly what that means for you in a few minutes. But if someone told you there is a 30-year-old catch-up loophole bridging the wealth gap, they were wrong, and now you will not waste a second chasing it. Okay, air cleared. Now the good stuff. The real 2026 reality. And it starts with a piece of genuinely good news that you probably did not even hear about, because good news rarely goes viral. For years, every tax expert in the country was warning about a cliff. The big 2017 tax cuts were scheduled to expire at the end of 2025, which meant that in 2026, your tax rates were supposed to jump right back up. Your standard deduction was supposed to shrink. Millions of single women were quietly bracing for a noticeably smaller paycheck. And then, in the middle of 2025, a new law stepped in and made those lower rates permanent. The cliff never came. The rates stayed low. And here is the part absolutely nobody is celebrating. Your standard deduction did not shrink at all. It actually went up. For 2026, the standard deduction for a single filer is $16,100. That is up from $15,750 the year before. So think about what that means. The first $16,100 you earn this year, the federal government does not tax one penny of it. That is not a loophole. That is just your baseline, and it quietly got bigger. The exact disaster everyone was bracing for turned into a small raise that you never even noticed landing in your lap. Now let us talk about why the number $200,000 matters so much for you specifically. Because this is the part the viral posts completely missed, and it is the real reason being a single earner under $200K is a genuine sweet spot in 2026. There are 2 extra taxes that quietly switch on the moment a single filer crosses $200,000. The first is called the net investment income tax. It is an extra 3.8% slapped right on top of your investment income, your dividends, your capital gains, your interest. The second is the additional Medicare tax. It is an extra 0.9% on your wages above that same line. And here's the kicker that should make you sit straight up. Those $200,000 thresholds are not adjusted for inflation. They have been frozen in place for over a decade. So every single year, as wages naturally rise, more and more women drift across that line and get quietly hit with taxes they did not even know existed. So if you are earning somewhere in the high five figures, all the way up to just under $200,000, you are sitting in what I call the Goldilocks zone. High enough to build serious, real wealth. Low enough to stay under that surtax line. And the entire game, the real strategy, is about choosing to stay on the right side of that line. On purpose. With intention. Not by accident. And to be clear, this is not pennies we are talking about. Picture a single woman who edges just over the line and has, say, $20,000 of investment gains in a year. That 3.8% surtax alone is an extra $760 on top of her regular tax, purely for crossing a line that nobody warned her about. Add the extra Medicare tax on her wages, and it climbs higher. These are quiet little taxes that do not send you a warning letter. They just show up year after year, the moment you drift across. And the whole point is that, as a single filer, you often have the power to not drift across at all. Which brings us to the actual loophole. And this one is real, it is fully legal, and wealthy people have quietly used it for decades. It is called controlling your modified adjusted gross income. Your MAGI. Now do not let the jargon scare you off. Think of your MAGI as the income number the IRS actually uses to decide what you owe and what you qualify for. It is the number that really matters. And here is the beautiful part. You have far more control over that number than anyone ever taught you. Because certain accounts let you lower it legally on purpose, whenever you choose. Here is how. When you put money into a traditional, pre-tax retirement account, that money comes straight off the top of your income before the IRS ever counts it. Lower MAGI. When you put money into a health savings account, the exact same thing happens. Lower MAGI. And this is the part one need you to really hear. You are not losing that money. You are simply moving it out of the IRS's reach and into your own accounts, where it grows for you, for your future, while it shrinks your tax bill at the very same time. It is the closest thing to free money the tax code offers, and it has been hiding in plain sight your whole life. Let me show you the 3 things a lower MAGI does for you, because this is where it goes from interesting to genuinely powerful. First, it cuts your tax bill this year, immediately, by pulling income out of your highest bracket. Once you are past about $50,000 of taxable income, every extra dollar is taxed at 22% or more, so every dollar you shift into a pre-tax account hands you 22 cents or more right back. Second, it keeps you under that $200,000 surtax line, so you completely dodge the extra Medicare and investment taxes. And third, and this is the one almost nobody connects, it can unlock the single best retirement account you will ever have access to. The Roth IRA. Here is why that third one is so huge. A Roth IRA is honestly a little bit magic. You put in money you have already paid tax on. It grows for decades untouched. And then you never pay tax on it again. Not on the growth. Not on the withdrawals in retirement. Not ever. But there is a catch, and it is an income catch. If you are single and your MAGI climbs too high, you get locked right out of contributing. For 2026, a single filer can put in the full amount only if your MAGI is under $153,000. Between $153,000 and $168,000, you get a reduced amount. And above $168,000, the door slams shut completely. So now watch what happens when you combine all of this together. Say you are a single woman earning $175,000 a year. On paper, you are over the Roth limit. Locked out, right? Not so fast. You max your pre-tax 401k, that is $24,500. And you fund your HSA another $4,400. Just like that, your MAGI drops to somewhere around $146,000. You just walked yourself back under the line. You unlocked the Roth. You cut this year's tax bill. And you stayed safely under the surtax threshold. One set of moves. 3 separate wins. That right there is the real loophole. And every piece of it is completely legal. So let us put the real numbers on the table, the actual 2026 figures, straight from the IRS. Your 401k. You can contribute $24,500 this year, up from $23,500 last year. Your IRA, whether traditional or Roth. $7,500, up from $7,000. And your HSA, if you have a high deductible health plan. $4,400 for individual coverage. Those are your 3 big buckets. And for most single women under 50, filling those buckets is not part of the game. It is the whole game. Now, about that catch-up contribution. Remember, it does not start at 30, no matter what the internet told you. It starts at 50. Once you turn 50, you can add an extra $8,000 to your 401k and an extra $1,100 to your IRA, on top of the regular limits. And there is a special turbo boost hiding in the law. Between the ages of 60 and 63, that 401k catch-up jumps all the way up to $11,250 a year. So if you are in your 30s or 40s right now, your move could not be simpler. Max the base limits. Build the habit. And know that those catch-up years are a powerful extra gear waiting patiently for you down the road. The wealth gap does not get bridged by a fake 30-year-old loophole. It gets bridged by quietly maxing what is actually in front of you, year after year after year. One quick heads up for the higher earners watching. Starting in 2026, if your wages last year were over $150,000, any catch-up contributions you make once you hit 50 have to go into a Roth account, not a pre-tax one. It is just a rule worth knowing so it does not surprise you later. And if your income is simply too high for a regular Roth IRA, sitting above that $168,000 ceiling, you're still not out of luck. There is a completely legal move called the backdoor Roth, where you contribute to a traditional IRA and then convert it over. It has been legal and common for years. Just have a tax professional help you do it cleanly the first time. Now, if you are on the other end of the range, earning less right now, do not tune out, because the tax code has something real for you too. And this one is an actual credit. Real, literal cash off your tax bill. It is called the Saver's Credit. If you are single with income under about $40,000 in 2026 and you put money into a retirement account, the government hands you back up to $1,000. Read that again. Not a deduction that shaves a little off your taxable income. A credit. Dollar for dollar, straight off what you owe. Almost nobody claims it because almost nobody knows it exists. If that is you, file the form and go take your money. Let me also set the record straight on the whole homeowner thing, since that fake solo homeowner credit keeps making the rounds. Here is what is actually, genuinely true for 2026. If you own a home and you itemize your deductions, you can still deduct your mortgage interest. And the cap on deducting your state and local taxes just jumped up to $40,000, which is a real, meaningful win if you live somewhere with high property taxes. But here is the part that stings, and you need to hear it. The home energy credits, the ones for solar panels and efficient windows and heat pumps, expired at the end of 2025. They are gone. So if some older article tells you to go grab the solar credit in 2026, that ship has already sailed. Never build a plan around money that is not there anymore. Now here is something I really want you to sit with, because it quietly flips this entire story on its head. Being a single filer is not the tax disadvantage everyone assumes it is. In one very specific and very important way, it is actually an advantage. You control your own MAGI completely. There is no spouse's income stacked on top of yours, secretly shoving you over a threshold you cannot do anything about. Your number is your number, and yours alone. So every single lever we just talked about, the 401k, the HSA, the Roth line, the surtax line, you can steer all of them entirely by yourself, with nobody else's paycheck muddying your math. That is real, quiet power. And most single women never realize they are holding it. Okay, let me hand you the simple playbook to actually use all of this. 5 moves. Grab a pen, because these are the ones that matter. Move 1. Find your MAGI. Pull up last year's tax return, look at your adjusted gross income, and get an honest, rough sense of where you are going to land this year. You cannot steer toward a line you refuse to look at. Move 2. Memorize your 2 target lines. $153,000 to keep your Roth IRA door open, and $200,000 to stay safely under the surtax. If you are anywhere close to either one of those lines, that is exactly where your pre-tax contributions go to work for you. Move 3. Fill your 3 buckets and do it in the right order. Grab any 401k match from your employer first, because that is pure free money and you never leave it on the table. Then fund your HSA if you have one, because dollar for dollar it is the most tax-advantaged account that exists anywhere. Then fill your IRA. For most single women under 50, that exact sequence is the entire strategy. Move 4. Pick your flavor, pre-tax or Roth. If lowering your income this year actually matters to you, to protect the Roth line or duck under the surtax, then go pre-tax. If you are already sitting comfortably under both lines, and you would rather have tax-free money waiting in retirement, then lean Roth. And if you are over the Roth ceiling entirely, that is when you look into the back door. Move 5. Grab every credit you genuinely qualify for and ignore the ones you do not. Take the saver's credit if your income is on the lower side. Take the real homeowner deductions if you itemize. And completely ignore, every single time, anything calling itself a women-only loophole or a solo homeowner credit. Because those will never save you a dime. They will only ever cost you. Now here is a small bonus move that makes all of this feel real in your actual life, not just at tax time. When you lower your taxable income with these contributions, you are also lowering the tax you owe across the whole year. So once your contributions are set, you can update your W-4 at work to stop overwithholding. That means a little more money landing in every single paycheck instead of waiting 12 months to get it back as a refund. A refund is just your own money the government held for free. Why wait for it? Adjust the dial and let the savings show up in your budget now, month after month. So here is the whole truth in one breath. There is no secret 2026 loophole built just for single women. But honestly, there is something better. There is a tax code that just quietly handed you permanent low rates and a bigger standard deduction. A clear, bright line at $200,000 that you get to stay under on purpose. And a set of everyday accounts that let you cut your tax bill, dodge the surtax, and unlock decades of tax-free growth, all at the same time, all by yourself. The women who win at taxes in 2026 are not the ones chasing viral loopholes that never existed in the first place. They're the ones who quietly understand their own MAGI and steer it like a seasoned pro. And now you're one of them. So go pull up your numbers, find your lines, and max your buckets before the year quietly runs out, because the deadline for most of this is very real, and it does not wait for anyone. If this cleared something up for you, do me a favor and send it to a friend who is single and absolutely crushing it at work. Because I promise you, she has already seen the fake version, and she deserves to have the real one.